Welcome to The Explainer. Today, we're totally dismantling 13 insanely expensive financial myths that are quietly, invisibly draining your net worth while you sleep. You might think you're making smart, responsible money moves, but it turns out a lot of conventional wisdom comes with a massive negative dollar sign attached to it. We're going to expose these myths today so you can stop leaking money and start building real wealth.
Look, to really get this, let's look at two totally different approaches. Meet Tyler and Sarah. Tyler, he's running on what we call emotional math. He makes financial decisions based on his gut instincts, what his parents told him, and what just feels right or safe. Sarah, on the other hand, relies entirely on actual math. She completely ignores the noise and uses cold, hard data to build her wealth. Throughout this explainer, we're going to see exactly how Sarah's actual math utterly destroys Tyler's emotional math.
Okay, let's dive into this. We're going to systematically bust these 13 myths by grouping them into 5 massive traps: the high cost of expertise, the market timing trap, the safe asset illusion, the excuse of time, and finally, the ultimate debt myth. All right, trap number 1, the high cost of expertise, or why the smart money actually loses.
So think about Tyler for a second. He's paying a financial advisor a 1% fee on his $200,000 portfolio. He's thinking, hey, it's just 1%, literally a penny on the dollar. It's practically a rounding error, right? Sounds totally harmless. But honestly, how much is that 1% fee actually going to cost him over the long haul?
$500,000, yeah, you heard that right. If Tyler's $200,000 grows at 8% a year for 30 years without that fee, he ends up with roughly $2 million. But with that tiny 1% fee, his growth gets choked down to 7%, leaving him at just $1.5 million. See, he didn't pay 1% once, he paid 1% every single year on a growing balance. That fee compounds against him with the exact same forces investments are supposed to compound for him.
And this perfectly bursts the next myth, the idea that picking stocks or paying high-end professionals somehow gets you better results. Over a 15-year stretch, 90% of actively managed funds, we're talking funds run by Wall Street pros with PhDs, massive research teams, and billion-dollar budgets, actually underperform a plain, basic S&P 500 index fund. You're literally paying a premium fee for worse results. The whole idea that high risk and intense stock picking automatically equal high reward? Total myth. Past a certain point, you're not investing, you're just gambling.
Moving right along to trap number 2, the market timing trap, and the very real danger of waiting. Look, everybody wants to buy low and sell high, but trying to actually time the market is a disaster. If you sit out and miss just the 10 best trading days over a 20-year period, your returns are literally cut in half. Think about that, just 10 days out of roughly 5,000. And honestly, the absolute cruelest part of this math, the market's absolute best days almost always happen right on the heels of the worst crashes.
Now, what's really interesting about this is the exact cost of panic. Let's check back in with Tyler and Sarah. They both throw $10,000 into the market in the year 2000, right before the massive dot-com bubble bursts. Tyler completely panics, sells everything at rock bottom, and just sits on the sidelines until 2013 when things finally felt safe again. But Sarah? She did absolutely nothing. She just ignored the noise and left it alone. By 2020, Tyler's tricky market timing got him to $17,000, but Sarah's lazy, passive approach absolutely crushed him, growing to over $30,000. Tyler's emotional timing literally cost him $13,000.
You see, when a crash hits, emotional math screams, sell everything. But the historical data tells a totally different story. In 2008, the S&P dropped 57%, right? But it fully recovered by 2013. In March 2020, it plunged 34%, but then bounced back in just 5 months. Listen, every single major crash in market history has been followed by a complete recovery that eventually surpassed the previous peak. A market crash isn't a funeral, guys. It's a clearance sale.
Okay, let's hit trap number 3, the safe asset illusion. We're talking real estate, dividends, and gold.
Let's rapidly break down these 3 quote-unquote safe bets that your uncle always swears by at Thanksgiving. First up, real estate. The myth is it always goes up, right? But the reality, adjusted for inflation, the average home actually appreciates roughly 1% per year compared to the S&P 500's 7%. Next, dividends. Everyone thinks it's free passive income, but the reality is, on the exact day a dividend is paid out, the stock's price drops by that exact dividend amount. You didn't just earn free money, your investment literally just moved cash from your left pocket to your right pocket. And then there's gold.
touted as the ultimate safe haven. Yet it sat with essentially flat real returns for 25 straight years from 1980 to 2005. It's a wealth preserver at best, not a wealth builder.
So the really crucial point here is that things aren't always what they seem, especially with real estate. Sure, your home might appreciate 1% per year after inflation, but you gotta consider the hidden carrying costs. Property taxes alone eat 1 to 2% of the home's value every single year. Insurance and maintenance, that takes another 1%. Throw in your HOA fees, plus the 5 to 6% closing costs when you finally decide to sell. Your primary home might feel like it's making you rich while you're Zillow surfing on a Friday night, but those hidden costs quietly devour 2 to 4% annually. A primary home is a fantastic place to live, for sure, but honestly, it's a pretty mediocre investment.
Trap number 4, the excuse of time. Feeling like you have too little or you're too young or too old.
First up is this massive myth that you need a ton of money just to get started. Well, fractional shares have completely obliterated that excuse. Today, you can buy a tiny slice of the most expensive tech stocks or an entire S&P 500 index fund for literally $1 single on most platforms. So that whole "I'll start when I have more money" excuse, yeah, that's completely dead.
Because here's the thing, the real cost isn't the money you invest, it's the time you waste. Check this out. If you invest just $300 a month until age 65 and you start at age 25, you walk away with over $1 million. But if you wait just 10 years and start at age 35, you end up with only $440,000. Waiting those 10 years didn't just cost you a little bit. It completely erased over $500,000 of compound growth. Compound interest desperately needs time, way more than it needs massive cash deposits. And by the way, you're never too old either. Even starting at 45 or 50 can still generate hundreds of thousands of dollars for your retirement.
And finally, trap number 5, the ultimate debt myth, the most expensive lie of all.
Now, this is where our two operating systems completely divide. Emotional math looks at debt and just feels sheer panic. It screams that all debt is dangerous and has to be destroyed immediately, just so you can sleep at night. But actual math? Actual math says, hold on a minute. Cheap debt, anything under 5 or 6% interest, is actually one of the most insanely powerful financial tools you have. It's leverage.
Let's walk through Tyler's quote-unquote responsible plan. So he's sitting on a $20,000 student loan at 4% interest. Step 1, he throws every penny of his extra cash, $500 a month, at the loan, aggressively killing it in just 3 years. Step 2, now that he's completely debt-free, he starts investing that same $500 a month for the next 30 years. Tyler feels incredibly smart. His parents are super proud of him. But what is the actual opportunity cost of this emotional plan?
$170,000. By relentlessly attacking cheap 4% debt, instead of just paying the minimums and investing that $500 at an 8% return from day one, Tyler completely sacrificed his absolute most powerful early compounding years. He ended up with $680,000 instead of $850,000. Now, let's be clear, if you've got a credit card charging you 20% interest, absolutely destroy that immediately. But lumping all debt together as bad and burning your most powerful investing dollars to kill cheap leverage, that is a devastatingly expensive lie. Which really brings us to the core takeaway of this entire explainer. The most expensive investing myth isn't just one of these 13. It is believing all of them at the exact same time. These myths, they don't exist in a vacuum. If you're paying high fees, trying to time the market, hoarding all your cash in a primary home, waiting around to invest, and overpaying cheap debt, well, those errors are compounding against you together. They're silently working as a team to destroy your financial future.
So I want to leave you with a really tough question. Are you letting emotional math run your portfolio? Because every single day you operate on gut instinct rather than actual data, it's costing you real money. Take a hard look at your accounts today. Which of these 13 myths is silently draining your future right now? Look, the math doesn't lie, but the choice to actually use it, that's entirely yours.